that's what's one of the really cool parts about it is that you can actually get some growth, some really exciting growth out of this asset class because it's kind of quirky and novel. It's not the risk is.
All right, what's up, everyone? Dan Habercost and Mason McDonald here today with another episode of the Big Picture Blueprint. What's going on, Mason?
Oh, it's been a great week. I've got sales manager in town from Texas coming out to Colorado and enjoying beautiful weather and driving around all over the state looking at land deals and closing land deals. But today we are not talking about land. We are talking about other alternative investments with our guest, Patrick Grimes, who is the founder and CEO of Passive Investing Mastery, an internationally best-selling author and a Forbes Council contributor. He's a serial entrepreneur that is specializing in alternative investments. His portfolio is diversified across energy, litigation finance, commercial lending, and acquisitions, including retail, industrial, and thousands of apartment units. He has developed a range of diversified passive investments focused on growth and cash flow, including the diversified litigation portfolio, acquisitions fund, and income fund. Formerly a robotics and automation engineer, Patrick holds a BS and MS in engineering and an MBA. So without further ado, let's bring Patrick in to talk about some alternative investments. Patrick, it's great to have you on the show. How are you doing today?
I'm doing well. I appreciate you having me. This is going to be a real fun discussion.
Yeah, absolutely. So a question that we ask a lot of our guests is there's kind of this weird dichotomy in the investing entrepreneurship world where people think that college and undergraduate or graduate school education is a big waste of time and a big waste of resources because there's YouTube University that can teach you anything and everything. And then there's other people that think that college was absolutely worth it and has been really great for business ownership and teaching you kind of the way to do things. What is your opinion on higher education and the world of entrepreneurship?
I love the question because I actually come from a family of educators. My father had three doctorates. My sister is a PhD, tenure PhD, clinical psychologist at San Diego State. And I kind of came from that. My mom actually worked for or ran schools growing up. So I am not the most educated. I mean, just a bachelor's in mechanical engineering, a master's in engineering, and an MBA makes me the underdog. And so my sister is quick to remind me that 2 master's degrees doesn't equal 1 PhD. I actually was, because of the kind of passionate way that I was raised around education. I was raised in the mountains, but I was constantly taken out into the wilderness with my family and constantly educated on everything from the geology to the biology and then in the stars. We were studying the stars, and it was interesting because I was raised conservative Christian, learning about stars 100 million light years away. And so it didn't quite make sense with some of the conservative theories, but it was interesting. Actually led my dad from a PhD in divinity to a PhD in education and then a PhD in evolution. Wow. But so I was raised super academic, but just like in alignment with that rich dad, poor dad kind of theme, I was not raised with any knowledge about money, about investing, about finances. And while I did really well in my career, my parents were like, "You're going to school, you're going to college," right? And it wasn't ever a thought, "Are you going?" It's where are you going to go? And it was a lot of focus on that. And I didn't really know anything different. When I went, I did good and I got a good job. And I think it helped me get, quite honestly, from kind of that scarcity, kind of just what am I going to do, bewilderment to, I found something. I changed my major 3 times and I found something I was passionate about that I like to do. I created income that allowed me to have possibilities. And I think education right off the bat can get you to that point. A lot of people find themselves in scarcity and they have family and kids and they're unable to think about, hey, do I have a balance growing in my account? What should I do with it? Right. And at that point, I went to the HR department and said, look, I would like accounting at payroll is all one lady. So I would like to get a piece of every paycheck to this random account and some other weird bank, and I'd like to start saving. And then I got raises. I started realizing, sure, I got this money. Now I can invest it. Well, a lot of the people I grew up with, a small mountain town on the south side of Yosemite, still to this day never got to that point, right? They never got to the point where they had surplus. And I think once you begin investing, if you be investing right, and we talk a lot about investment strategies and non-correlated investments and allocations, like the wealthy, and you can get to not only from scarcity, but to a point of security, financial security, not in one investment, but in lots of ones that don't rise and fall together. That truly our mission of passive investing mastery is to get past scarcity, outside of just independence, to financial security, to a point in which you can contribute towards the causes you care about most: family, friends, hobbies, philanthropic. So I do think education helped me, not only in the problem solving skills and the confidence, but it helped me at least get a job that was paying enough to begin that journey.
I think that was a really great answer, and one of the best answers we've actually had on this show, because everyone's dogmatic and has their own biases and everything, no matter if you think you are or think you're not. And I feel like within this entrepreneurial space, so often people are so focused on the idea of financial freedom and being their own boss, and they're telling that and trying to sell that to people that have never made a dollar in their life. And it's okay to get a job. It's okay to follow the herd for a little bit and get good at something and develop a savings account so where you have the ability to invest, because, we make fun of it all the time. There's not really a way to invest in real estate or anything with no and low money down. Yeah, there's some creative financing solutions and all that kind of stuff that kind of works sometimes, but you need money to make money to a certain extent, and education can provide that foundation, depending on how you utilize it. Not everything needs the formalized education, but no, Patrick, I think that was a great answer. And before we really dive into the show, can you kind of tell us, so, you got a few letters behind your name, not as much as your sister, which, in case she's listening, you're so much cooler than Patrick, you're better than him. But
I'll make sure she does.
Right. Can you tell us about what you're doing today, what your business looks like, what you're focusing on here in 2025?
Yeah. So at this point, we're to where I've kind of had success in automation robotics. I've had some success in real estate. And so I'm at a point now where I find myself kind of looking at the breadcrumbs of the wealthy on how they invest and how you build stability. We didn't talk about it, but I actually lost everything in 2008 and 9 because I was all in real estate. And, I was in high tech at the same time. So that's a very volatile industry. I realized most of my wealth was in these like kind of volatile, cyclic sort of things. And so I wanted to get allocations into different things. So you do the pie chart of my wealth, and it was just super overweighted in these things that made me nervous when I went to bed at night, right? And that's actually so true today because, we see these traditional investments, market sentiment driven stock market, as well as not necessarily residential, but commercial real estate, just a huge dive. I mean, it's the biggest buying opportunity in my life. So in commercial real estate, or lending opportunity in commercial real estate, right? Interest rates high, all these distress operators post-COVID. So we find ourselves pouncing on the opportunity to help investors get their capital out of the cyclic markets and into kind of novel, unique other things, right? Like opportunistic funds that take advantage of the downturn in real estate, or other recession-resilient markets that are typically sought after by hedge funds or sovereign funds or endowments, ones that, and they're counter-cyclical or completely do not care what's going on right now in the stock market, oil and gas, interest rates, or any of the other markets. And those are things like the legal industry. Just doesn't care. Steady growth, medical, people need healthcare, education. It doesn't matter what's going on. Reskilling, upskilling, CPA firms. Those are kinds of things. The industries that have the fundamentals which can support. How to access those investments are much fewer known. And while it's easy kind of to get into a real estate deal or maybe an oil and gas deal, get some non-correlated returns, we're helping to provide things like, hey, what about a legal investment? What about investment in an industry which has just gone up? That's it. Doesn't simply care about anything else. And how can you participate in a way in which you can get outsized growth at a time when you can go to sleep at night going, man, don't care that the stock market just took a 2,000 point roller coaster right now because my wife came and asked me if we had how much we had in the stock market. And I told her, she goes, great. And then walked away. And that was the end of our conversation about that, because our allocation was so little because we have it in different buckets. Right. Does that make sense?
Yeah. Yeah. So, okay, there's a lot of follow-up questions I think both of us have, but just to clarify your story, I know you said you went belly up in '08 because you were only in real estate. Was that you were only in single family rentals, or had you amassed the multifamily portfolio, or where were you at when things crashed in '08?
Snot-nosed engineer and just saving up pennies. And I got some advice from the founder of the company, actually, at that time. When I was thinking he was going to say, oh, go invest in this startup or this high-tech company or this medical device, because we have the insider track because we're doing automated equipment for these guys. He said, go invest in alternatives, make it in high tech, and put your money elsewhere. And so I put it into a pre-development. And so I did a bunch of research, actually, and they had a great track record. Of course, not decades long track record. And I didn't look at downturns. I didn't understand recession resilience and recession resilient markets. I didn't understand safe leverage. At that point, market was never going to go down. I didn't understand the fact that I could be upside down on this thing I personally guaranteed, and they could come after me personally. And all that happened, and I lost it, and I was able to do debt forgiveness, but the gotcha is the forgiveness is taxable. So then the IRS came after me after that on the forgiven debt afterwards. Yeah, I wasn't able to avoid BK, but that was my ego battered, bruised, humbling start to alternatives. So that's what
Okay.
happened.
And then how did you pick yourself up, take the lessons you learned, and start over? Did you keep working the job and diversify right away, or what did that look like, getting back on your feet?
I love to say that I just woke up the next morning jumping up and down, doing jumping jacks and handstands. And, I always was a successful engineer up until I walked away from it. So I was still gainfully employed. And so I just doubled down in my career. And that's when I chose to get an MBA and a master's in engineering at the time. After that, I traveled the world a couple times, actually, 2 different gap years. But after that, I went to kind of be a bigger fish in a smaller pond. Did another automation house, started making great bonuses again. And then I knew, I saw the voice in the back of my head, I didn't want to ride the high tech world for my entire life. It wasn't going to create the security that I needed for my family. And I needed to allocate into other investments. So that's when I kind of revisited, figuring out how to do things a little more patiently, tortoise, not the hare, and then traded from, singles, family, existing construction, cash flowing, up to apartments, and then energy, and then debt, private credit, and legal funding, litigation finance, stuff like that.
Okay. All right. What I was trying to get to, and you answered there, is where you or how you made your first substantial nest egg in order to be able to diversify. Because I think a lot of people that don't have any sort of net worth yet are trying to diversify. And if you only have 50, 100 grand in net worth, you probably just need to make money. And so it's good to hear that you kept working your job, which probably paid pretty well, which allowed you to continue to save and build up a nest egg so you can even get to the point of truly investing. And then it's compounding, where your investments made money, your job's making money, the interest from your investments is reinvested. And then that's really where it starts to snowball. And so that's what I was trying to get at. Okay, let's dive into the different industries you're in. The litigation, that's really interesting to me. Can you tell us a little bit about that space and how you're investing in it?
Sure. Well, anytime you find an industry where it's super attractive to me, I mean, you find an industry just steady Eddie growth. It's kind of like looking at single family home values in Texas, right? In Houston specifically, like as even when 2008-9 happened, they just maybe leveled off slightly and then kept going. Like we look at that same graph for legal services and it doesn't flinch. It just keeps going. And so you look at something that's that attractive, you got to figure out how to solve a need in that industry. And the niche that is in that industry, because it's it's a very simple industry. It's not like an airline manufacturer where there's tier 1, tier 3 suppliers, there's tens of thousands of parts, and there's tens of thousands of people involved. Super simple. You got attorneys, you got paralegals, you got a reception, you got rent, you've got court fees, filing fees, and hourly rates. Basically, it's very simple. We also have marketing because we got to bring on new clients, right? And for the most part, a lot of the industry has those attorneys are working for wealthy people that pay them and that can afford them. But there turns out to be a whole industry of attorneys out there that are offering service, just access to justice, representation for those who can't, either through a pro bono or through a contingency fee-based representation, which means that they would meet with them and say, look, I'm not going to do this for free, but I'll go ahead and I'll take your case. Or they'll say, hey, look, I've already got a case going. I got 1,000 people in there. Would you like to be added to this case? We don't do class action stuff because that's maybe what you're thinking, because really people make like $50, $70 off that. Nobody really wins. We do something else, either individual cases like sexual assault or labor claims, or cases that are mass tort, they're called, like mass harm, where like in Camp Lejeune for 17 years, our military, civilians and their families were poisoned by contaminated water, right? Or Roundup or paraquat. Landscapers and farmers were poisoned, even though they were said it was safe. Or our firefighters were poisoned by this aqueous firefighter foam, right, that they used, and they said it was safe. They said you could eat it. Turns out it's horrific illnesses. Baby infant formula, right, that had heavy metals and toxic ingredients, causing major problems. Where those are kinds of cases in which there's hundreds of thousands, 102, 400, 500,000 plus sometimes in these, and it makes meaningful difference for these individuals, and they otherwise wouldn't have access to justice. So it's not like we got like a ambulance chaser, type of billboard up somewhere. We're actually trying to do something good and produce great returns at the same time. But essentially, these guys, they need finances. These attorneys, it's got to come from somewhere. And they know they have a good case. So they go to private credit. Banks don't lend on that kind of stuff. There's too much regulatory environment imposed by the federal government. There's only certain things they can lend on that have certain sort of back-end insurance, right? And so they can't bring on investors that are partners. So unlike a normal startup, if they have like a really good exit and a really good business plan, and they're going to have this multiple or a sale or whatever, they do a Series A, Series B, Series C, bring on a board of directors, and they would, board of directors might throw out the CEO. I mean, that's how it usually happens, right? Turns out attorneys have ethics problems. So they can't have anybody in there making any decisions, pressuring them to violate that attorney-client relationship. And so they have to have an outsider. They have to have somebody do essentially a structured loan, right? Somebody who doesn't have a stake, can't control what's going on. And so that puts them in kind of this quirky space. And so we can fulfill that need. And essentially, just like how asset-backed lending works in real estate, where you have an operator who wants to buy a property or improve a property or both, and he wants to provide access to housing to somebody who's going to pay rent. And then we would lend potentially to that operator like we do in our debt fund. And we would look for skin in the game. We'd do an appraisal. We do a loan to value. We put a lien on it, right? And we would monitor capital as they use it to improve the property to make sure that the job's getting done, right? We'll do all of that same stuff in the asset-backed lending in litigation finance. We'll find operators in the legal industry, attorneys which have a track record and have skin in the game. They have an asset, which is their list of clients. And these are contingency fee-based agreements with these clients, which means a law firm valuation specialists can come in and appraise it. They can go through and figure out all these cases. Like they can look at their proof of medical records or symptoms, look at their proof of exposure or proof of harm, and look at the case. And we're always in really late stage cases, and so you can see what is that worth, right? We can come up with a value of that. Similar way appraiser works in real estate. We can lend on a loan to value of that. Require certain skin in the game. We're typically 10, 20, 30%. And we structure a little bit more like investments, not technically a loan per se. We do, and then we get a lien. We'll put a lien, just like you do. It's a UCC1 filing. It's not like a mortgage, right? But it's a UCC1 filing lien against that asset. And then either they're going to use it for operating expenses to provide access to justice, or they're going to use it to market and build out more cases and they're going to go through the motions whether or not they have 100 or 1,000 or 2,000 or 3,000, right? So they can get more people that are similarly harmed, they can get more justice for more people, get more claimants paid out, and a higher piece of the pie for themselves. So sometimes they'll say, hey, look, we want expenses for marketing. And just like if you were putting in expenses for CapEx in real estate, you would want to see as they spent it and you send it out in layers, are they actually doing the work to increase the value of the collateral? We can do the same. We can invest a certain tranche and then see their marketing wheel go and see how many new claimants they got, assess that, continue to layer it out. Almost identical in almost all aspects to what we're doing in our debt portfolio, right? We can also do in all other kinds of asset-backed lending, including the legal industry. And it's just another way to do it.
That's really interesting, and it's a interesting niche you found there. And just so I can kind of summarize it and explain it, or how I see it, is there's attorneys out there that they need financing because they're taking on cases that potentially they're not going to get paid paid unless they're successful. You provide that financing, you have a certain amount of control over, maybe not exactly where it's being allocated towards, but you're aware of where it's being allocated towards. It's secure because, the attorney's been in business for a while and you have a specialist go in and examine the case, I guess. And then, the attorney gives you your money back with interest, which you're able to distribute to your investors. Is that only dependent on the success of the case or cases that the attorneys you are lending to are, having? Is it like success-based, or?
It's a really good question, and I think you did a pretty good summary. Maybe I'll tweak a couple of things while I answer the question. So just like in any investment strategy, you can have a really risky investment that has a big chance of total loss or a massive gain, right? You can be an angel or seed investor in a company, and maybe a third of them will lose everything. Third of them will maybe break even. Maybe a quarter of them will be a win. Oil and gas, wildcatting, right? Make it huge, lose it all super early on, right? Kind of convert that to litigation finance, right? And you can get involved in cases that are super speculative. They haven't actually been filed. You're just putting the seed funding up essentially to assess, is this the case? And you can potentially get 30, 50x returns on that, but you also might lose it all. I've lost it all once before, so it's not really our jam. We got really late stage, meaning that these cases have actually gone through a lot of the motions. And they've been in the courts. They've either had very similar, identical cases settled, so you have the evaluation specialists really good handle on what the worth is of these cases. It's important to notice that that 90% of civil cases do settle. So by the time you get to that point, it's typically you're asking the question of how much and when. But we do have what's called attrition. It's like maybe some of them don't pay out. Maybe, we don't know. Like just like in real estate, how you have vacancy or you have bad debt. Even people that sign a contract saying they'll pay, maybe there's a percentage of them that don't. We underwrite similar things like attrition. Maybe some of these cases, and there are thousands of cases, like thousands of individuals, right, that we have in the fund. Maybe a percentage of those will fall out based on what you've seen before typically in the space. So you underwrite all that. And it's not typically, so we don't have the control. You just need to know, like I said, that's one word, is we actually can't have specific control over the attorney. But to your point, we can understand the sources and uses, essentially, where they're going to put it to operating expenses or marketing. If they're putting it towards marketing, there's a chance to layer it out, make sure that we see the cases come through that marketing. But the other piece is we're not actually collecting like interest. It's not technically a loan in that way. Whereas in our debt fund and any other kind of lending, you basically have your principal and then an interest payment, and that's it. And your upside. What's really cool about litigation finance is they do have some of that. For the most part, these attorneys, they're given either it's like a straight split on fees, and there's certain states that allow you to do that, fee splitting, like Arizona. But some of the states don't. Some of the other states, what we do is we do kind of a waterfall where, like one of our cases, for example, it's like a 1.3x on our invested capital, where we get 100% of it back. So you got to get 100 plus a 1 plus a 30%. And then after that, you get to participate in the upside. And it's like a waterfall, like maybe 75% from a 1.3 to 1.8. then maybe 50% we get from 1.8 to a 2.2, and then 25% up to like a 5 or a 10x or something usually cap. But what's really cool about that is we're investing essentially into a diversified portfolio of all the cases these guys have. Typically, it's in numerous. It's about usually 500 to 1,000 individuals in different cases they're pursuing. So there's kind of a diversification into a diversified collateral pool. You get, the idea is you get your capital back plus some before they participate in anything. And most of the larger cases, portfolios, other than like this kind of single event ones where it's just straight fee split. And then you get up some of the upside, right? And that's what's one of the really cool parts about it, is that you can actually get some growth, some really exciting growth out of this asset class, because it's kind of quirky and novel. It's not, the returns have not been priced out of it like they have in the stock market or like they have in real estate. You can access these and still get a really strong risk-adjusted return.
That's really, really fascinating. And it's really cool whenever you find a niche like this where you're able to just discover it and be like, oh, is this really how it works? Is it this simple and this much upside? And it's the truth, whether it's in the legal industry or the film industry or medical industry or any of them. But is there a reason beyond it just makes sense and you've kind of figured out the system that you're sticking with legal as versus one of those other potential alternative investments like film or medical or anything you could possibly think of that exists that's similar to this?
Well, so we have private credit in real estate. We also have acquisitions in commercial real estate. It happens to be the best time of my life to do debt and equity in real estate. And those are doing incredible because we're just riding the curve right now. All commercial though. Then we do have legal. We've done energy already. We've done some oil and gas. What we teach at our company is all the different kinds of non-correlated. You can go to investwithpatrick.com. And on that website, it's Patrick's favorite non-correlated alternative investments you can make today to start building stability in completely different markets, ones that don't ride the same fundamentals. And so we don't say stop here or stop there. We do in the background have all kinds of really cool stuff in the works related to acquiring CPA firms, right? Those are ones that are needed regardless of the downturn. We have medical receivables we're working on in the background, right? That's stuff that we don't have forward facing. We have a number of different other completely non-correlated investments, including precious metals. I am a big precious metal guy, and technology metals and precious metals, that's on my list, right? Those are things that I think belong in anybody's portfolio, especially today. And so those are all things that are very important. And although we have deals and we sponsor it, every 2 weeks, we present on completely different asset classes. I bring in 2 or 3 panelists to feature a completely different, we call it an Alternative Investing Mastery Series. And we've done Forex, blockchain, gold mining, silver, parking lots, laundromats. We've done, just extraordinary, we just did one on bourbon barrel and whiskey cask, as well as alcohol brand investing. That's really interesting. The cask of whiskey and bourbon is really interesting. Just did one on tequila, wine investing. Done a lot. It's just a long list of really completely different alternatives that when you get that diversified, you start to sleep a little better at night, although it takes some energy to educate yourself and get out there, find the right people. But when you get out and you start putting pieces in other markets, you start realizing, I actually feel not so bad when one piece dies, because I know some others are going out. Gold portfolios up 40%, right? And just because I allocated in gold and silver outside of the stock market and some of my liquid capital, it doesn't matter so much, right? When I see the deflating dollar, because the gold's way out, it paced the deflation of my dollar and liquid capital.
Oh yeah. Well, and I have to ask, I love whiskey, Scotch specifically. Certified Scotch professional in a whiskey club and all that kind of stuff. Obsessed with it. When you say bourbon barrel investing, I assume it's something along the lines of, in Scotland, a lot of Scotch is finished in bourbon, finished in bourbon barrels or aged in bourbon barrels, even if it's not the finished product. With an investment like that, how does it look just working with some of these companies? Because, with minimum age statements on a lot of these bottles of whiskey being, 9, 12, 18 years. They have to project out what's going on. And we're recording this April 10th, 2025. God only knows what's going on with tariffs and liquor taxes and everything else going on in the world. Can you speak to that particular investment class a little bit, just for my own knowledge? And
yeah, it's a fascinating one. Yeah, because you've got this asset that doesn't produce cash flow, right? You've got this liquid in a barrel, and the barrels, and if they're in America, the bourbon barrels usually come from Canada. So tariffs would obviously affect the price of those. But once you put it down into these barrels, it's usually 2, I think minimum. I think normally people go to 4 years because it's very uncommon to see less than 4 years in a bourbon. And there's requirements to be called a bourbon for the ingredients and the amount of time it's in a barrel, right? And actually, I live on Oahu. The only bourbon you can buy is one that hasn't been around long enough to be called a bourbon. So I actually do drink Holly Road bourbon, but it's actually still a whiskey technically. But yeah, so you essentially in some of those cases, you're going to buy a lot of these distilleries. They just want to exit from the liquid. So you can, if they're not wanting to exit from the liquid, then they're potentially usually putting them down by themselves on their own in their own. But a lot of these distilleries, they just don't have that kind of capital, right? They're a lot of churn and burn. And so what they'll do is they'll sell the juice. You put it in a barrel, or they put it in a barrel, and they'll sell you the barrel. And those barrels can be, $5,000 up to $50,000, right? And you would essentially, as an investor, own your own barrel. And we don't offer this investment. Just to be clear, we educate others on all the other investments out there. I'd like show my whole hand and all deck. So you actually could own 5 or 10 barrels in a warehouse somewhere with your name on it, and those are yours. But basically, they'll raise enough capital from individual investors to pay for the storage, the temperature control for say 4 to 8 years with insurance and everything. And then you'll lose about 2.5% a year on whiskey, just from the angel share, they call it. We call it devil share goes in the cask and the angel share goes in the sky. And then that helps to condense the flavors. And then on the tequila aging side, which is actually a huge growth market right now, mezcal tequila aging, it's like the new Scotch, right? I don't know if you've been involved in that, but it's the typical tequilas that are like 70% agave that they give you really bad headaches. Those are the ones that everybody knows about. But then there's 100% agave refined and aged tequilas that are really taking off, and that's the biggest growth market for alcohol bev right now, and especially in the aging market. But you would similarly age, but you're losing like 4.5% a year. So those are typically aged like 3 years, right, to get to that the higher grade tequilas, and then you sell it back. You can either go for, hey, it's mine and I want to sell it to who I want, or the people that sold you this juice, they'll have a guaranteed buyback contract based on minimums, and then there's a bunch of ways that it works. But interestingly enough, and I happen to have worked at the world's largest winery for a while as a process engineer and did some stuff. So there was actually a distillery and a winery at Ernest and Julio Gallo. So I got a little bit of knowledge there on it. So I got passionate about wine, kind of, and learned about distilling and brewing beer and all that stuff pretty early on in my career. So, but it turns out that even in downturns, like in COVID, alcohol bev skyrocketed. And when things get tougher, people tend to drink more. The difference is that beer is trending down, fine wine is trending down. So that also means that the longer you keep it, the less supply it is, the less competition, because it's consumed. So you can usually hang on to it a little bit longer and become a little bit more scarce. But you want to make sure, if you are in that market, that you're trending on an up, right, type of asset where you see a lot of that bourbon and tequila. I think the other thing you talked about was tariffs. Oh my gosh, yeah, I met with Germany, with a supplier in Germany, and he was kind of freaking out a little bit because he was worried. Their biggest consumer is in America. And thank goodness that they did put an exception in for the tariffs. And right now, but then this latest hit with the 90-day pause, which we're in the middle of right now, could change all that. And so it could be very tough. However, the bourbon guys that are sourcing the liquids nationally and supplying the liquids nationally are in really good shape, because if it's really expensive to bring in bourbon, we're one of the biggest bourbon drinkers on the planet here in America. then it's really good for them. So that's one reshoring effect of tariffs right there, right? And then ultimately, India is the biggest consumer of whiskey in the world, like half. The point is that there's a lot of really exciting alts out there, and we have zero to no financial education in America. And I was working with some of the smartest people I didn't work with. I actually drive a Tesla now, but I actually helped with robotic systems to assemble their rotor. Like I was working on satellites for Lockheed. I was working on medical devices and bioabsorbing drug eluting stents for Abbott and all kinds of really cool stuff. And, but none of those people in any of those jobs knew that there was more to investing than just high tech being Bitcoin and hopefully their startup goes well. And now that's why every, biweekly we have this alternative investing mastery series, just kind of like show my hand, right? I used to just trade the baseball cards of all assets with just a handful of deeds. And now I'm just trying to get it all after showing them now that went well. So I'm showing the whole deck, right? They're not our deals, and I can't represent that they're good investments or bad investments because we haven't, do due diligence on them. We have our own select ones that we offer, but they're all out there. And it's great to be part of the solution. Show people, right? Here's all the alternatives that you can get involved in.
Interesting. Okay. I know nothing about alcohol, so that's all Mason. I know I can handle about one whiskey drink and then I'm done. So I'll take us to what most of our listeners know, and that's real estate. And I'm interested in what you said there, where you think that this is likely one of the biggest buying opportunities for commercial real estate, at least in our lifetime. So can you speak to what you mean specifically? Are you talking apartments? Are you guys buying strip centers, former office? Can we specify there? And then, well, I'll have a follow-up question, but can you specify first which assets?
Yep. Yeah. So the best buying entry in residential real estate was back in 2009 and 10 when I was getting raked over to coals and I didn't have the chance. So happens to be in this market right now. Commercial real estate was hit by a myriad of things, right?
Yeah.
As you probably are aware, the last thing that happened was interest rates skyrocketed, right? But prior to that, you saw a lot of stress put on other factors, like you had an eviction moratorium. For the first time, people couldn't collect rents. I mean, think about it. What if you're a shop owner and everybody on your block every day could come in, fill up their basket of groceries and go home every single day? And you couldn't, and that was like 3-6 months. And then at the end of that, they said, okay, it's lifted. Then the backlog was 18 months in places like Atlanta. Like for 18 months, people were still coming into that grocery store or living in your apartment and collecting those groceries or not paying rent for free before the sheriff showed up. So it was just complete decimating to any forecast, to the liquidity. So you got to add that up to the fact that payroll and material costs skyrocketed. So whether you're doing development or you're paying people to lease up or maintain the property, everything has gone up. And then all these natural disasters hit. And insurance companies are straight up leaving markets. It's not whether or not you think, we should be worried about global warming. It's just a financial disaster. The fact that so many different hurricanes have rocked the southeastern states in Texas, not the Midwest portfolio. Actually, our insurance went down in the Midwest, but the southeastern states in Texas so badly that insurance carriers would leave 20, 30, 50% increases in some markets, double, or you can't get it at all in some places like Florida, which puts you in default of the loans. So commercial real estate just got hit by just a myriad of things, all culminating in the fact that interest rates skyrocketed and there was a record high amount of short-term bridge loans that were done prior to COVID, which means they're all coming due when the expenses have inflated, the rents have gone down, right? And so that operating income that you're valued off of is shrunken dramatically. And so what they're stuck, what are they going to do? And so those distressed operators, they need something, they need a solution. Meanwhile, banks are on the sidelines because their bond values got devaluated. Their liquidity events aren't happening because of the stress. So just like in 2009, private debt skyrocketed for residential, and people that bought right made huge returns. So we have two sister funds. We have an income fund that is a real estate asset-backed debt fund that provides debt to operators that need or want more time. You're going to pay a little bit higher interest rate. These used to be 6, 7, 8%. Now we're lending at 12, 13, 14%. But we're reliable. We're not going to jerk them around. We're going to make it happen. PIM Rapid Lending is our originator. We're going to provide those loans, and our investors get extraordinary returns for debt. I mean, some of our investors are getting returns like they're in equity, but it's on a low risk debt portfolio. But if those operators, they don't need or want more time, they're just like, look, I'm done. I want out. But at the same time, if they've got a good property, some of them are just financially distressed, but they ran out of money, they ran out of time, and they need out. And we can, in the acquisitions fund, just pick it up in cash, right? And that's what we do there. So it's the haircut, but we can be part of the solution on those two sides. And that's how we're really taking advantage of the upside of the downturn. And it's working great.
And so we're talking about multifamily apartments.
No, we actually, that's within scope. Sorry, I forgot to answer that question. That's within the only thing that's not in our buy box is office. To point, you did mention office. I think office is a hot knife, and I've taken a look at office several different ways. I really don't think there's an opportunity there yet. They're going to have to rezone, rethink how these buildings can be converted, because you just can't make livable space out of the way that these things are structured, and the cost to do so is so catastrophically expensive. They just don't pencil. So I'm not sure how office is going to recover. It's going to have to be a completely different take. That's going to require some government intervention. And only about 5% of it can be even converted. But off the office topic, multifamily still, we're underwriting we're underwriting multifamily, a lot of industrial, because we've seen during and post-COVID, especially with this, I mean, now we're going to see tariff implications, but during and post-COVID, a lot of reshoring happening, whether it's the warehousing, the manufacturing, right? We're seeing a lot of this industrial stuff really take a surge in some target markets for us in this, the eastern south. Also retail centers, where these guys, man, they didn't have a lot of reserves. They just got hit real hard. They just need to exit. We're getting some really strong returns on those. We haven't yet got a multifamily deal in the fund. It's kind of annoying to me because I actually love it, but man, they're still not quite penciling. And there's a whole lot better opportunities right now, and some of these other aspects of commercial real estate, aside from office, that have populated the majority of our fund at this time.
Okay, I have two questions for you. One simple, one more lengthy. Do you a lot of what you're saying? Have you read anything by Howard Marks, Oak Tree Capital?
I don't think so. The name is familiar, but I don't think I have. Yeah,
okay. His memos are I get excited when they come out, and I read them 3 or 4 times, and a lot of what he talks about reminds me of what you're doing. So that's why I was curious. But yeah, you'll have to read it if you want extremely clear, concise thinking and planning from someone who's been in the business for 50 years. It's a great person to read. But what I wanted to bring up, so I read, he had a memo that came out yesterday, and I read it. It talked a lot about, he went through from Black Monday to the Great Recession to all these different events, and how it always feels awful in the moment when there is opportunity, right? Everyone's scared. Everything's super uncertain. It doesn't feel good to go out and buy. So how are you underwriting these deals and thinking about all the uncertainty and risk, and getting to a point where you feel confident enough to loan to these distressed operators and or buy the assets directly? How do you think about that?
Well, actually, I would pose a different question. I don't know how they're doing it in residential real estate, because the market's so inflated right now. They're lending to really high loan to values, and they're lending to after repaired values or after completed values, which are theoretical. They're not even real. What we have the benefit of doing now in commercial real estate is, after we've seen a massive devaluation in the market, we can do an accurate appraisal today, right? And as a result of that, we can lend on a very conservative loan to value. And what's really good is my partner, Lance, been doing this for over 10 years. I mean, he started a fund administration company, grew it from zero to 2 billion, private equity from 0 to 500,000. He's got 15 years in debt experience. And actually we got together after a lending conference in Vegas, like a few years back, like, this is the time. Let's do a debt fund together, because this is like the one time of life. So what we have the luxury of doing is actually lending at current value, loan to current value, not theoretical hope, that they're going to finish a construction or do a renovation. We're not lending the actual CapEx budget, right? We're actually lending loan to current value. And we're lending right now, it's a 58% loan to value on average throughout the portfolio. And that's after we saw a collapse. That is a huge amount of cushion, right? From that'll absorb future fluctuations in the market. So it's actually really cool. That's why we call it the recessionary income fund. And on the acquisition side, you'd be surprised. People are willing to par with deals today. They're distressed, they're exhausted, they're tired. A lot of them, some of them, some of them are mom and pops. They inherited it from their dad. They never really operating it. And then all of a sudden things got distressed and they realize they got to get out. Some people are distressed elsewhere in their portfolio and they're wanting to exit this quickly to save other things. So we're getting a lot of opportunity, mostly direct to the owner, right? There are some brokers involved sometimes, but a lot of the times it's just direct owner. And then sometimes they may circle back, but we uncover. It's really about that big pipeline. In 2009 and 10, the people that made billions off of the subprime mortgage collapse, they bought right? Not buying, hoping to get a value through injecting capital and making improvements. They made the return on the buy. And that's the entire intention of the acquisitions fund, and we've been killing it. So.
Yeah, that is exciting. I can relate to what you're saying about these sellers inheriting a property or they're struggling elsewhere in their business, and so they're just looking to liquidate an asset. And I have several more questions, but are you focused in any particular part of the country? Are you all over? Speaking specifically of real estate.
And actually, we kind of drew a big circle, not in Florida and not in the coastal regions of Texas, and then just a little bit in the Midwest, and kind of like not New York and not DC. Like we just, but then for each asset class, there's certain submarkets which are highly favorable. And so we actually kind of do spearfish a bit in certain areas based on where we really see some industrial resurgence. But on the other side too, like our pipelines, we got tens of thousands of deals in there. We're doing mass market, direct to owner. And so some degree, it's kind of like, okay, here's the broad target. And then let's get some marketing out. And then once we start getting interest back, we start to fine tune, right? Which are the ones, and like, we'll get 3 to 6 deals under LOI, and then when we get into the due diligence, as you say, sometimes there's more distress than we like, and we actually want performing assets. So a lot of those fall out. So we work real hard to make sure that the hopper is really full and so that we can only choose the right deals.
Patrick, I'm looking on your website and you've got a pretty decent sized team operating these funds. Not gigantic team, but a decent sized team. Can you talk a little bit about the structuring of the individual funds, Reg D, 506C, 506B, however that is, and then the team that you've put in place and the rationale behind the organizational chart and structure you've created to manage all this?
Sure. So with Passive Investing Mastery, we have right now the 3 active funds. We have our thought leadership and education, right? So there's really kind of like 4 business units to Passive Investing Mastery. And so for each of the funds, I have operating partners. So Lance is my partner in the income fund, Lance Peterson. Amazing guy. It's very difficult to find people of 10, 15 years, running similar kinds of strategies. He exited companies and then he's like, hey, now's the time to jump back in. We've been trying to work together for a long time. So I figured out a way to make it happen. So I partnered with him and he runs the chief investment officer, originations, and I run kind of the operating side on the front end. And then we have, to your point, like, well, who manages the bookkeeping and accounting? We actually transferred the entire bookkeeping and accounting and CFO service to an enterprise solution. That helps us, fund administration enterprise solution. That helps us be able to very quickly check the boxes, to some higher net worth individuals to get that third party. So we have other people managing the books. So we originate all our own loans in the income fund. Similarly, David Gooseman in the diversified litigation portfolio, he's my partner over there. And I started talking with this guy like 4 or 5 years ago on real estate, found out he was in alternatives, working for institutions, originating private credit deals like litigation finance or Amazon warehousing or different things for these $20, $30, $50 million per check investors. And I tried to get involved in some of these back then, but he was like, nah, we won't take anything less than 20 million. So he actually hung his hat up in private equity a few years back and called me and said, hey man, let's do something together. And so that's how we created the diversified litigation portfolio. So he's on that side, and we originate all the investments ourselves with we have, and with both of these loans, we both have securities counsels. We have lending attorneys that put the financing agreements together. We have due diligence people that appraise or evaluate the law firms, and so there's actually a bunch, to your point, there's a bunch of other people like stitched together. Acquisitions fund's a pretty big animal, right? Because you've got a ton of properties, you've got acquisitions teams, you've got property management, asset management involved in there. And we've got a huge hopper with, overseas marketing, churning through with a huge CRM database with a bunch of complex software that we've integrated to really try and find distress in unique ways that normally people wouldn't uncover. And so there's just this mass marketing effort that goes out. And then we have underwriting. And so we have underwriters that help across funds because we have underwriters specifically for litigation fund, but we have underwriters who can help in the debt as well as the acquisitions fund. And then we have the educational piece as well. So, and that is, I think I mentioned, I write a bunch of books, and I contribute to a bunch of books. I contribute to Forbes. Got a bunch of articles out, and we do a weekly PIM Wealth Accelerator every Saturday morning. I share some aspect of that I've learned over the years. And then we have our bi-weekly live alternative investing mastery series, where we do a deep dive with 2 or 3 other experts in a niche, and you can ask any question you want live, and that's why we do it, and we go deep into it. Then there's like a myriad of people probably on that org chart that kind of support, right, a lot of that stuff, and some full-time, some part-time. Is that the answer you're looking for?
Yeah, almost all of it, except, like what type of funds are these?
There you go. Yeah. So all of my funds since inception have been Reg D 506C funds. And that is, means accredited investors only at 100,000 minimums. Maybe if you're getting involved in more than one deal simultaneously, we'll split the 100,000 up. But we made that decision early on because I like to get out there and educate. And unless we file in that way, with all those characters and numbers, and limited to accredited investors, I can't talk about my funds publicly. I can't solicit public. I can never educate people on this exciting asset class. Now, if you're not accredited, that's cool. Let me know, because as you probably are getting, we have like 50 to 100 different alternative investing sponsors in our Rolodex that we've actually had, right? And I can get you pointed in the right direction, set up a call. We can figure out where you're at, and I'm happy to help. That's one of the things I love to do. But if you're accredited and you're interested in coming in 100,000 chip sizes, we've got some really interesting investments for you that mean that if you're in them, the turmoil we're in right now wouldn't mean much at all to you. Right? So, and it's kind of a good feeling.
One thing we like to always ask any of our guests is, are there any questions that you think we should have asked that we didn't?
I think what I usually tell investors that are out there, a lot of people are kind of doing what their parents did, and they're using a financial planner, or maybe they just have a 401k. And, fortunately, a 401k was never meant to be the solution. It was meant to get encouragement back into the stock market after the Great Depression. And the age of the financial planners is inherently a conflict of interest because they can only sell, according to their quote, fiduciary duties, what they're only educated in, and that's more sentiment-driven investments. And then there's kind of like this what I call it the ruse of REITs. I write about that, where REITs are really, truly not. They're paper. They're not real estate. And I think that there's a lot of people out there that are successful that just kind of are ignoring their investments. Oh, I'm doing what I've been told is right. And that's what I could have done too. My family didn't educate me. Nobody came to me. I had to go out there and find it, right? And learn about it. And there's this sense of like fear when you step out into the unknown. But there's also a sense of fear for continuing the way you are now, right? Because you do live in fear. You worry, when's the next stock market crash? What's going to happen when interest rates rise? What happens if there's a recession and I lose my job? I mean, I rode that high-tech wave for my whole career. I get it. But if you take the chance, I say do one passive step a day. I run every single morning. And I write with the dog or the beach or whatever, but I'm listening to a podcast, educational, or an audiobook, educational, or a TED Talk, inspirational, or something. And I take one step a day every day to educate myself and take myself and reprogram my brain to think in different ways and get more comfortable with different terminologies on different investing strategies. And that's really served me throughout my life. Then take one step every week. Get to one step every week. Maybe it's one step every 2 weeks to physically get around other people that think of finances as something you want to be successful in life, not just being a better doctor, lawyer, whatever it is, mechanical engineer. People that know how to earn, but also know how to invest. And the challenge is that we are inherently nomadic, tribal, group-oriented people, and nobody wants to step out and wander into the wilderness or into the desert alone. And that's a survival gut instinct you have. Even though the tribe you're in may be heading in a dangerous direction where you have insecurity in your financial future, you worry about the stability of your investments to be able to serve your family in your later years, or the ability for you to retire altogether because you're overly indexed into one sentiment-driven market, you will probably by nature stay with that huddle. So to make it more natural, instead of just stepping out on your own, find ways to get in front of meetups or investment groups or go to some workshops. Find ways to get around other people that won't be worried about you, because these people want to pull you back in. They'll worry about you because you're doing different things. But people that would be encouraging you and cheering you on. And it wasn't until I started doing that I really started seeing, I started developing this network of people that were thinking like and doing things I wanted to become. But I really was able to build that confidence and build that ability to dive in to alternatives. Each time I did that, I felt more comfortable. I felt more secure with the overall security for my family, which is really what matters, right? For the ability to have funds that support us later in life. And so the payoff is good. The steps are easy. Just take small steps every day, once a week. But the payoff is great. And maybe one day, like, you'll end up, maybe your wife will come out and say, hey, let's move to Hawaii. And you just choose to do it, right? Because you can, right? You're not locked down because you've made good steps along the way. So that's what I usually tell people. Just start making an effort. Set up a call too. I'm happy to get you along the way. If you want me to give away a copy of the book, I'll do that.
Well said. Yeah. Share where people can set up a call with you, where they can get in touch with you, where they can find the book.
Okay. So, well, first, investwithpatrick.com. It's a new link. We're trying this out. Investwithpatrick.com. If you go there, you can download Patrick's favorite alternative investments. It's a PDF. It's a quick one page on the front. And on that, it's favorite alternative investments that anybody can invest in today to begin building more security in your portfolio. It's non-correlated investments. Begin investing in today. And that is like the no-brainer. I get asked that question more than any. So we created that. Sure, it goes more details than the ones you want to talk about later, but check out that, because if anything, that will help. If you're needing some encouragement on your journey and you're working hard and you want to see a path out, well, I've done a couple books where I contributed a chapter. I give away a copy of this for free because I think I get a lot of feedback. It inspires people. And it's just not my story too. Like, I hear on the cover, and then there's a Navy SEAL like here. Super cool dude. I mean, and there's Phil Collins, lead guitarist of Def Leppard, an actual rock star. And then there's NFL, NBA players on here. This was an awesome book to write. Brian Tracy did the Ford, Kim Eastman, Tom Ziegler, Dennis Waitley, Bob Berg. I mean, I had such a great time, and I did a chapter and wrote my whole story about the ups and downs from high tech, losing it all, coming back, and how I grew and learned about all its assets and how I got away from it all, and what we're doing at Passive. I tell my whole story in there. If you go to passiveinvestingmastery.com/book, that's the secret link. Put the name of the podcast in the form. If we don't ship it out, I don't sign it. We don't ship it out if you're a random. We get a lot of randoms. But if we know where you came from, I'll sign it. We ship it out. And you can either download the ebook or download the ebook and get a hard copy. And it's free. And if that helps to encourage people along their journey, then that's enough for me. But if you want to set up a call, like I said, happy to talk to anybody, regardless of where you're at, and get you pointed in the right direction.
Patrick, awesome. Thank you so much for all of that. We'll make sure to include it in the show notes and reference our show, The Big Picture Blueprint here. But That is all for today. This is Mason McDonald with Dan Haberkost and Patrick Grimes for the Big Picture Blueprint signing off.